The stock market has never been richer. And yet, for many people, life has never felt more expensive. Every headline says markets are booming, stocks are up, indexes are near all-time highs, but wages, housing, and daily life tell a very different story. This episode is about that gap, not the gap between optimism and pessimism, but the gap between financial markets and the real economy. Before we go further, one quick thing. If you want to follow our work consistently, please like this video, subscribe to the channel, and click the notification bell. It really matters for the channel. Now, this is not about blaming markets, and it's not about predictions. It's about understanding how today's financial system actually works. If you've ever wondered why growth doesn't feel like prosperity anymore, stay with me. Chapter 1. A common misunderstanding. If you've ever felt that markets are celebrating while daily life feels harder, this is where the misunderstanding begins. Most people believe the stock market is a mirror of GDP, employment, wages, consumption. But this assumption is wrong. The stock market is not a picture of today's economy. It is a pricing mechanism. And what it prices is not reality, but future cash flows filtered through financial conditions. This confusion explains most frustration. When people say the market makes no sense, they are usually comparing today's lived experience with tomorrow's discounted expectations. Two different clocks, two different systems. And this difference in timing matters. Markets can adjust in seconds. Prices move instantly. The real economy adjusts through contracts, wages, and investment cycles. That delay creates the illusion of contradiction, when in reality, it is simply a difference in speed. Chapter 2. What the stock market really prices. At its core, the stock market prices only three things: expected cash flows, risk, and the price of time. Nothing else. It does not price inequality. It does not price job quality. It does not price political stress. Those factors matter to society, but they enter markets only when they affect cash flows or risk perception. This is why markets can rise even when economic sentiment deteriorates. Not because markets are blind, but because they are selective. They filter reality through a financial lens. That lens compresses complexity. Millions of individual situations are reduced to a few financial variables. This simplification is not a judgment. It is a requirement for prices to exist at all. Chapter 3. Financial conditions versus economic conditions. Here is a distinction most people miss. Economic conditions describe production, employment, wages, consumption. Financial conditions describe interest rates, liquidity, credit, and discount rates. Markets respond first to financial conditions. When liquidity stabilizes, when rates stop rising, when credit remains available, asset prices adjust, often before the economy improves. Markets don't forecast well-being. They reprice constraints. When constraints ease, markets respond immediately, even if households and businesses haven't felt the change yet. This is why financial relief often appears in prices before it appears in daily life. Chapter 4. Who actually owns the stock market? Another uncomfortable truth. The stock market does not represent the average citizen. It represents capital. Pension funds, insurance companies, asset managers, sovereign wealth funds. These institutions manage vast pools of long-term savings. Their decisions are driven by asset allocation, duration, and risk budgets, not day-to-day consumption. When capital reallocates, markets move. Even if daily economic life does not change, this is not a flaw. It is how the system is designed. Chapter 5. Who owns capital and why it still affects everyone. Here's where the picture becomes more subtle. While markets are dominated by institutions, those institutions do not own capital for themselves. They manage capital on behalf of millions of individuals. In practice, a large share of stock market ownership is indirect. Many people don't own stocks directly. They own them through pension funds, retirement accounts, mutual funds, and ETFs. So when we say institutions own the market, What we really mean is that institutions act as intermediaries for household savings. The average worker may not trade stocks, but their retirement balance, their pension entitlements, their long-term savings are often tied to equity markets. This creates a bridge between markets and everyday life, not through wages, but through wealth perception. This is where the wealth effect appears. When asset prices rise, people feel wealthier, they may spend more, they may save less, they may feel more confident about the future. Nothing real has changed yet, no new factory, no higher productivity, but balance sheets look stronger. That perception can influence behavior, even without immediate economic improvement. That is the wealth effect. And it explains why market moves can feel disconnected from lived reality, while still having real economic consequences over time. Chapter 6. Discount rates change everything. One of the most powerful and misunderstood forces in markets is the discount rate. When discount rates fall, future cash flows become more valuable, long-duration assets rise, growth assets outperform. Even if current earnings are weak, when discount rates rise, the opposite happens. Even strong economies can experience falling markets. This is why markets can rally during slow growth phases and fall during strong economic expansions. The driver is not growth, it is the price of time. Chapter 7. Why the gap feels larger today. The disconnect feels stronger today for structural reasons. Capital ownership is concentrated, financial markets are global, economic pain is local at the same time. Central banks influence financial conditions, while governments manage economic conditions. Two policy domains, two objectives. Markets and the real economy are connected, but they are no longer synchronized. Synchronization used to be tighter. Today, capital moves globally, while economic conditions remain local. This structural divergence makes the gap more visible and more emotionally charged. Final takeaway. The stock market is not broken, and it is not disconnected by accident. It simply does not price what most people think it does. It prices future cash flows, risk, and time. The real economy reflects income, costs, productivity, and lived experience. When you compare the two directly, confusion is inevitable, but when you understand the structure, the contradiction disappears. Markets are not irrational. They are conditional, and understanding those conditions is the real edge. Thank you for watching Money Veterans. Less noise, more strategy, and don't forget to activate the notification bell to follow our work consistently. See you in the next episode.